as we speak right now. As you're continuing to come on, hey, good afternoon. Have you ever wondered why some people always seem to win in the stock market? Tonight our guest speaker is going to be to show you the path to consistently winning in the market. And so I'm going to introduce him here shortly, but I want to get a couple of admin things out of the way. First is one, if you have questions, drop them into the chat box. The reason for that is because we want to capture a recording of the questions. If you put them in the Q&A section, they don't record as well. So just in case we don't get to any of your questions, but I will be monitoring questions as we go. And I know John's going to be providing a break or so, a couple of breaks along the way for you to ask questions. And so just a real quick summary of where we're going here. And here's where we set with the autopilot trading system and what we do on the BAMM. There was our P&L for last year. And here's where we're at this year. We're a little bit behind schedule, but still clicking up, and we'll hit our target of 40% by the end of the year. And we are currently beating the S&P with a return of about 14.75. And that is basically it. And here's just John's our speaker for tonight. Then next month, Lee Tanner will be, my good old Navy buddy, will be speaking with us, and we'll be looking forward to that. And that'll be coming out on the 19th of July. So now, I told you I was going to be really quick about this, folks. Yes, thank you, Troy, for bringing that up. If you have a question, please make it go to everyone in the chat box so everyone can see it. That way we all learn together. So, I'm thrilled to introduce our special guest speaker for tonight's Bay Area Moneymaker IBD Meetup, John Pokaroba. John is not only the IBD Meetup leader, but he is also the founder of Rain King LLC. He's been helping investors since 2016, and tonight he's here to share what it takes for you to be a winning trader. John's journey in investing began back in the early 1990s. I think John and I started investing about 1987, John, so you probably around the same time frame, early 90s.
Early 90s, yep.
Yeah. And when he picked up Bill O'Neill's book, How to Make Money in Stocks, and like many of us, he made a lot of mistakes along the ways. I'm sure he stubbed his toe. I don't know if he blew up any accounts like I did, but but in 2024, he got serious about improving his results and attended some high-level workshops. One led by Bill O'Neill himself, which transformed John's approach. Now, after over 24 years of experience and using Can Slim methodology, John has become a master trader. So the past 2 years, John has shared his market insight on his YouTube channel at Rain King LLC, and accurately predicted both the major market moves, and soon will be launching his own new website, RainKingInsights.com, and we'll be placing and providing in the email we send out with your access to the recording, all the links to what John will be talking about tonight, and I'm sure he's going to give you his email. And so let's see here. So tonight, John will discuss the key traits of a successful trader, including mindset, process, patience, and confidence. Get ready to learn from one of the best and take your trading to the next level. And John, I hope you're going to work or basically talk a little bit tonight about how to handle the mindset monkeys.
The mindset monkeys, yes, emotions, and definitely we get inside our heads a lot. We'll talk a little bit about how to work with that.
So with no further ado, John, All you have to do is click there to basically start sharing your stuff, and away we go. The floor is yours, my friend.
Okay. Okay, you can see my screen okay?
Yes.
All right. So good evening for those of you on the East Coast, and I guess good afternoon on the West Coast. Thanks again, Dennis, for having me. It's really, it's great. I have not spoken to this group, but I know I've seen the names, and I know it's just a great group, and I know your group is doing really well too. So tonight we're going to talk about, what it takes to be a winner. And for some of you, this might be just a refresher of some concepts, which will be good in itself. But for other people, maybe on the call, and you might get some new insights. You might get some new ideas that maybe help you level up your trading. So I guess I encourage you to take what works, grab any of the nuggets that you think will help you with your trading, and hopefully the presentation will give you some stuff to work with. So I'm going to shut off my video because I think I don't want to block any potential slides. And let me hide these controls, and let's do this. So yes, I'm with Rain King LLC, and obviously the presentation's for educational purposes. So the talk title is what it takes to be a winner. And we all talk about winners, and we think, well, winning stocks, the winning picking stocks, and are we talking about winning traders? In general, if you're following the Can Slim methodology or just a growth stock methodology, we all trade the same stocks. But yet some people are kind of consistently winners, while other people are consistently losers, or they struggle, or they even quit trading. So, why is that? Now, it really comes down to you. It comes down to kind of what's in our head and how we apply things. It comes down to emotions and mindset and discipline. And so we're going to talk a lot about a lot of intangible factors that really make a difference. And you're going to see very, very few charts in this presentation. A lot of presentations show chart after chart. You're going to see a couple, but not too many. You're not going to see much on magic indicators. And I think it's important that to be a winner, you don't need to take huge risk, and you don't need oversized positions, and you don't even need a large account. It's all about the intangibles to improve your performance. So as Dennis mentioned, there's a lot of qualities here, and I probably could make this list even longer, but there's only time tonight to talk to these four. We're going to talk about mindset and process, patience and confidence. And not only are we going to talk about defining what these are and how they affect your trading, but we're also going to share a couple of best practices, things you might want to consider if one of these elements currently you see as a weakness for yourself, because we're always looking to improve. So let's dig into mindset. So winners, winners really treat trading like a business. It's a very serious endeavor. And I think anybody who's done trading and to get good at it, it takes quite a bit of effort. People that consistently lose just have an approach that is trading is just gambling. And they're seeking the thrill of kind of placing a bet, and they want action, and they want to see something potentially, hit the big one. And trading is really approached from a gambling perspective versus really saying, look, we want consistent results. We want to approach it with a methodology. And so what does this all mean by a business? Well, as with any business, and you're probably, as a trader, you're a one-person business. It's going to take time, it's going to take effort, and you got to have capitalization to get started, and you need to manage your capital. It's really important. We know in trading that you're going to take losses and there's going to be setbacks. So it's really important that your plan, you have to stay afloat during the setbacks and the losses until your business can become consistently profitable. And that takes time. You don't start trading on the first of the month, your first trade, and say, oh yeah, in a couple of months, I'm going to be consistently profitable. It takes time, and it's a hard work. Now, in any business, we're trying to grow a business or growing your capital, you got to manage risks along the way. And most businesses, successful businesses, plow a certain portion of their profits back into the business. Now, in trading, that would mean, investing in yourself. You want to put some time into further training. You want to put education, learning new things, and self-improvement, research, doing your own market research. And you also need to know how your business is going to be profitable. And we're going to talk about edge. You have to have an edge in the market in order to be profitable for this business venture to really, really work out. As I mentioned, losers are really, really thrill seeking. It's all about, easy money. The market is seen as this big casino. And that leaves them very, very susceptible to tips and rumors and watching FinTwit for ideas. And, there really is an attitude of, well, I'm a pretty smart person. I went to college or I got a doctorate degree and I'm going to beat the market. And probably one of the most dangerous things is when you're starting out, if you have one pretty good win in a trade, and then you say, okay, I'm going to just roll it all over and let it ride on the next trade. And that attitude is, it's just gambling. I mean, you think, well, I got house money, so what if I lose it? Well, a winning mindset says, if I make gains, I want to fight really hard. I don't want to give back gains. I want to follow my edge and my methodology, and we'll talk about process. But we never think of things as house money. That's dangerous. That's a different mindset. That's not something that winners embrace. Now, losers tend to never calculate their risks. They don't really invest in education, and they don't really do post-analysis. It's just a big gambling game. So we don't want to be there. That's not really going to help us. Now, the reality of trading is we have to cut losses. And not only, there's a physical capital or account, but probably even more important is the stuff we're talking about tonight, the psychological capital. If you make some big mistakes, your psychology is going to be really thrown off, and that capital drain can affect your trading effectively. Now, bear markets, if you've been through the market cycle before once or twice, you always get grounded because you realize that you're not as smart as maybe you thought you were. Big losses in the market can create a lot of pressure, loss of confidence, affects your decision making. And as I mentioned, there's a lot of psychological damage if you're not on top of your game. Now, if you're a professional trader and you take big losses, you could be risking your career if you really, really make some big mistakes. Now, retail traders, smaller traders, the damage could be fear. You're fearful of taking the next trade. You have emotional scars of what's happened in the past, and you get very timid. You get afraid, and you potentially could miss the next big opportunity, the next bull market. So psychological capital is very, very important to this game. So what can we do about this? What can we do about this mindset? How do we put some practices in here to help us build and retrain our mind to think a little differently than from the general public to try and help us get better results? So we're going to go over 3 practices, and we're going to go over some examples of what they are and some suggestions of what you could consider for your own trading. Now, the first practice is, a mind shift of thinking in probabilities. Trading is a very difficult game. The stock market is all about uncertainty. Nothing is certain in the markets. The markets can, go anywhere. So if we think in probabilities, essentially when we make a trade, we're placing a bet. And we're placing a bet on, we can control the direction. Do we want to be long or short? And how much are we going to bet? What's the size of the position? Now, what's unique about trading, which is different than maybe betting on a sports or a horse race, is we can change our bet at any time. If you want to get out of the trade, with today's trading, you can, with a click of a keyboard, you can close the trade and you can change your bet. So, when a coin flip, there's a 50% chance of being right. So, if we take that a little further, this coin flip analogy, there's kind of a random distribution of flips. And in this example, if we flip a coin and we try to predict, is it going to be heads or tails? And every time we get it wrong, we're going to lose $1. But every time we get it right, it's going to pay us $2 when we're right. And so, if you use a simulation of just 10 flips, and we say, okay, it's equal distribution, there's going to be 5 of each, 5 winners and 5 losers, the 5 winners yield $10 and the 5 losers, you only lose $5. So you say, geez, if I could do that over and over again, I'm going to be profitable in the long run. You don't need to predict with accuracy exactly what's going to happen next, because your edge is built in if you have the discipline to follow it consistently through the ups and downs. So we want to be thinking in probabilities, because all we're trying to do when we're placing a trade is, we can look at all kinds of indicators, et cetera, and setups. We're trying to stack the odds as much as we can to get a positive flip. So if we shift a little bit to the casino game of roulette, roulette is, I'll say, almost a 50% game, because you do have the zero number, and some boards now have double zero. So it's a little less than 50%, but it's probably the closest you're going to get at a casino. Now, one of the things in a roulette game is, we always have to be aware of these losing streaks. This is called clustering effect. There's going to be good trades that we're going to make, and we're going to be bad trades that we're going to make. But we also understand that when we have a good cluster of trades and we make 2 or 3 good trades in a row, there's potential to get overconfident. Now, when we have bad clusters of trades, we could have serious drawdowns if we're not managing our risk. We could have, multiple trades in a row, and if we're taking too much risk, we could blow up the account. So on a roulette spin, every 32 spins is going to be a cluster of either 5 red or 5 black. So we have to be able to survive the clusters. And what I mean by that is, if you're taking big positions, let's say you're taking a 20% size position on one spin, and you get 5 cluster of 5 trades that go against you, your account is gone. So position size and these clusters, we have to be able to survive that. And I've shown up here in the upper right corner here, this is just a little table, which I think is kind of interesting. It shows, if you know what your win rate is, and let's assume, what I mean by win rate is, out of every 10 trades, how many times are you have a winning trade? So if you say, look, I'm every 3 trades out of 10, I'm successful. My win rate is 30%, 3 out of 10. And you say, well, here's the predictability of consecutive losses. So what this is saying is, if I only am right 30% of the time, there could be 5 consecutive losses. There's a 17% chance that we have a cluster of 5. Now, if my win rate is 70%, I'm really, really, really good. And now my game, you can see the cluster of 5 is going to be much, much smaller. So depending on, you can see also, what's my odds of having 2 trades in a row that are bad, or 3. Interesting little chart. And I think we probably are all familiar with, losing streaks that, depending on how much you're risking on a trade or your account, you can see that, a good rule of thumb, don't risk more than 1% of your account on a trade. Well, this just shows you how many trades you can take in a row. You could lose 10 in a row at 1%, and you haven't lost but 10% of your account. If you're risking 3 to 5% on a trade, you can see how devastating these losses become. After only that cluster of 5, you've dug a pretty good hole. So understanding math is pretty simple. But the math behind your losses, is really, really important, because it works geometrically against you. And, if you can't keep your losses small, and I'll say this, you have no chance. You have 0 chance if you can't keep your losses small. So let's look at this a little deeper. So understanding the math. So this is one of the few charts in the entire presentation. This is Upstart from 2022, kind of a real rocket ship late in the bull market. So it peaked at 401. Now, if you're not cutting losses and you don't really recognize that the market is going into a correction, it corrects, but you say, well, I'm going to buy some more. Maybe I'll buy more here. I'm a real holder. I believe in the story. You can see that the stock just continues to get hammered as the market was topping in late 2021. Gaps down. You say, Jars, now I'm really, really stuck. I can't sell now because now I'm really underwater. I'm going to wait for a bounce and then I'll sell. And there is no bounce. The hole gets deeper very, very quickly, and you're really caught. Now, you do get a bounce here, and you say, wow, the stock's coming back. I really should have averaged down. I'd be really averaging down, which is, kind of a cardinal sin. I would never, ever average down. And then you say, what happened? Well, the stock continues to go lower and lower. And at this point, the stock's 90% off its high. How low can it go? And you just say to yourself, it's too appetizing. I'm going to buy 1,000 shares and catch this bounce. It's going to rally. I'm going to catch this thing on sale. Well, the stock went further and further down. At this point, the stock's 95% off its highs. But you, believe it or not, you've lost 50% of your money. From 42 or 41 to 22, you've lost half of your money, even in this little period here, because you were bottom fishing. So losses have to be cut. You can get really caught in a bad psychological state, as well as losing physical capital. So the losses work against you. And this table is just trying to show you that if you take a 5% loss on a stock, you're going to need a 5.3% gain to get back to break even. That's what this table's about. What does it take to get back to break even? You take a 10% loss, you need to make 11% back. These two are workable. We can work within these parameters. You start taking 20% losses, you got to make 25% to get it back. 40%, it's staggering to say, geez, now I got to make 67%. And if you take 50% losses, you've got to double your money. That's very hard to do. Now, some of you out there are more aggressive traders. You might use margin. Well, this is what the table looks like if you use 2-to-1 margin. If you're using 2-to-1 margin, you take a 5% loss, you need 11.1% to get back to even. Only a 10% loss needs 25% to get back to even. And you can just see that you get in serious, serious trouble. Even a 20% loss, you can recover from when you're not on margin. It's becoming very, very daunting to say you've got to make 67% to get back to even. So, and God forbid you take a 50% loss on margin because you're broke. So, scenario planning is one thing that we can do. And we want to always be very, very aware of our trading edge because it is about probabilities. And we also want to be able to plan for defense and manage risk. At the same time, we also want to manage and making a plan to be on the offense. We want to take advantage when the opportunity is there and the odds are in our favor. We want to step on the gas, but you have to be able to decipher what kind of market you're in and where are you with your positions. So you got to have confidence that you can use your edge and it'll work over time. We know that most traders, will have more losing trades than winners. So you've got to get yourself in a mindset to saying, look, I'm going to take a lot of losses, but as long as I keep them small, and my other trades are a multiple of those risks, I'm going to be a winner over time. Losing trades is not bad trading. So you really have to work at that. That's a mindset. Losing trades are part of the business. You just take the loss and you move on. And you preserve your capital for the next opportunity. Now, if you have a failure viewpoint and you just think, oh, I'm losing trades and I'm lost 3 in a row and I'm down, I'm depressed, I don't know what to do. Well, that mindset is really, really going to hurt you because it's going to limit your risk taking. And you could be truncating your opportunities when the market is opening the window of opportunity. Because if you're unwilling to take risk, it's really all over. Forget it. You're dead as a trader. If you can't put on risk, and I'm going to say managed risk, you're not going to be a trader. If you just think everything's going to go against you and you only want to make little tiny trades, it's going to be very, very difficult to really be successful. So we can use mental rehearsal to help with this. So one thing you can do is when you're getting ready to put on a trade, you can actually mentally visualize and rehearse in your brain, in your mind, visualize, I'm going to be stopped out. You're taking a trade, you've got a stop loss in place, and you say, okay, if that trade gets stopped out, I get stopped out, and I'm going to take this amount of loss, and you take the loss mentally. If you're really uncomfortable with that amount of loss, then there's something not right. Your brain is not aligned. Your emotions are not aligned with your trade plan. If you can't even imagine being stopped out and taking the loss that you've planned for, there's something really, really that's not in alignment. Your brain and emotion are in conflict. And what that does is that battle, you end up basically audible your trade plan. If you have a trade plan, you set a stop, you want to let the trade play out. Now, if you're in this conflict, this mental washing machine, you might sell before your stop is even hit because you get scared. Or if your stock's working, but you haven't hit your profit target, you might still take the trade off because you're just worried. You're worried about, I don't want to lose the profit like I did last time, so I'm going to sell it early. These are signs that you're not following your trade plan, and you're operating essentially from a position of fear. And if you're operating from fear and you're emotional after you've created a trade plan, you really messed up your edge. Don't forget, your edge is, if we call R, risk, 1R is your stop, and you want to make a multiple, 2R, 3R, 4R, 5R in profits. If you start truncating trades left and right and doing this, you just messed up the edge. It's not going to work over time because you're making emotional decisions. You're essentially sabotaging your plan. So let's look at a scenario here where let's assume you took a few losses in a row and you're not feeling great. Okay, you've taken maybe 3 losses, 4 losses in a row, and you're mentally wounded. Now, let's say your typical position size that you take is 10%, and you typically want to risk 5% on the trade. So you're going to risk 0.5% of the account. Now, let's say you're looking for 15% profit on this trade. So we're risking 5%, want to make 15. You're a 3-to-1 trader. If R is 5%, 3R is 15. Now, in this example, you're just taking 3 or 4 losses in a row. So this next trade comes out, looks pretty good, but due to the recent losses, you've decided, well, I'm going to size this down. I'm not feeling too good about this. I'm going to size it down to 5%. So what happens? Well, of course, that's the trade that works. And it goes up and it hits that 15% target. Now, the target is hit really, really quickly. Now, let's assume there's 2 traders. Trader A, do you feel pleased or do you feel unfulfilled because you're sized way too small? Same trade, same profit target was hit, but there's different feelings involved. Now, if we take this one step further, this idea of trader A and trader B, trader B, if you feel really bummed out, you're trapped really in a lose-lose mindset. You actually had a winning trade, okay? But you're feeling bad because you're saying, well, I sized it too small. I really could have made more money. So you're not feeling good about that. And you've messed up your sense of achievement and you've messed up your headspace. You're in a lose-lose mindset because you took a smaller trade. You probably messed up the edge. So trader A, who would probably be more of a consistent winner, would say, look, I'm going to take my gain. I maintain my edge within my trading plan. That was a 3-to-1 trade. Yeah, the size might have been smaller, but we move on to the next trade. Now, in general, I would say initial position size, and you have to decide what's comfortable for you, but the initial position size in your trades should be the same size. And the reason I say that is, when you're in a horse race and they come running out of the gate, you don't know who the winning horse will be. So when you get a follow through day and you put 3 or 4 positions on, you have no idea which one's going to be the big winner. So, if you load up on one you think will be the big winner and go smaller on the others, you might be positioned on the wrong horse. So that's why we typically start with the same size. And the market will tell you which one's going to be the winning horse, and you can gradually add to the position. Now, if you're really, really fearful about that size that you typically put on, don't take the trade. If the environment's bad for your trading system, don't take the trade. Now, an exception to it might be you can put on a very small probe position, really 2-3% in size, if you just want to put something out there to kind of get the feel of the market. So let's look at this closer about the math. Now, position risk, I mentioned before, as a rule of thumb, you really don't want to risk more than 1% to 1.5% risk on an individual trade. Personally, I keep mine to below 1%. I try to stay in the 0.5%. Because I typically have only a 35% win rate. So I keep that less than 1% per trade because I know I'm going to have, losers that I need to work through. Now, you should always be aware of position risk, but you also have to be aware of portfolio risk. So if you were using 1% risk, but you've got 5 open positions and they all got stopped out, you could lose 5% of your portfolio very, very quickly. And you have to ask yourself, is that acceptable to you from a physical capital? And is that acceptable to you psychologically? 5% of your capital in one day, some people, that's not acceptable. Okay, so you need to really think about the position, but also roll them up. What is the cumulative if you were stopped out on everything? Now, as a general rule, I would strive to keep portfolio drawdowns to no more than 10 to 15% max from equity highs. And the reason I use that as a guide is because those losses and drawdowns work geometrically against you, as we showed. It's very difficult to recover if you take a 30 to 40% drawdown in your portfolio. If you have $1 million account, you take a 30% drawdown, and your account shrinks down to 700,000, you need 43% gain just to get back to even. You're not even making ground from where you started. So that's a good rule of thumb to use. Some of you might have it tighter, but it's something you want to have in your mind. You want to run these scenarios to anticipate worst case outcomes. Now, you need to know your edge. Many of you on this call probably say you do know your edge. Now, in order to know your edge, you have to know your own trading statistics. This is not something that I or anybody else can give to you, but you need to know your win-loss ratio or your batting average. I mentioned it earlier, out of 10 trades, how many of them do you typically get correct over the course of 12 months? 3 out of 10, 4 out of 10, 5 out of 10, 2 out of 10. And you want to know what is your average gain and what's your average loss. So these 3 sides of the triangle are really important basics of a trading plan. You got to know your batting average and the average gain and the average loss. So if you're not tracking these today, it's really important that you track these for a period of time. You need to know your numbers. That's when your trading gets real. Now, gut feel is not an edge. And I don't care how successful you are in your primary career, that's not an edge either. Just because you think you're smart at whatever your primary career is, that's not going to help you with trading. So you need to know these statistics and start tracking them. Now let's look at how we can put them together. So on the edge, we want to have a methodology that we're going to use this edge. Now, we have to have a way to know what are the market conditions. Are we in an uptrend or are we in a downtrend? We want to invest as growth stock traders in uptrends. We use the follow-through day concept, and there's other devices we can use to get into the market. And we also need to know when the market is correcting or topping and when we should be reducing our exposure. Now, your methodology, you should have defined setups, that you have really gotten good at the setups. And so I've monitored myself and I'm really good at whether it's, cup with handles, or I'm really good at trading gaps, or I'm really good at trading pullbacks. You should know what you're good at. And the only reason you're going to know that is if you track it. You should really track your setups over time to say, geez, I never knew it, but I'm really good at trading gaps and I'm terrible at trading pullbacks. That can inform your post analysis and your actual trading plan as you go into the next quarter or the next year. So having those stats is important, and you got to have a position sizing strategy and a risk management strategy. Now, it's interesting that CanSlim doesn't talk about this in the book as, quote, edge, but it does have a built-in edge. Bill recommends cutting your losses at 7% and taking your gains at 20%. That's a 3-to-1 ratio. That's the edge in CanSlim. So that's why he's saying take gains at 20%. And the 20% is not arbitrary. It came from, he studied that the distance between bases, stocks tend to go up 20, 25%, and they base. So he's saying use that money, take the profits, roll it into the next stock. So there's a built-in one edge with CanSlim. So again, when you're trying to develop your plan and you're running scenarios, you got to have a portfolio size, your position size, what is my desired return? What am I trying to do in my business plan for my trading plan? And you got to know those statistics, average gain, average loser, and your batting average to even have a chance at getting the math to align you with a successful plan. Then you're going to have to develop some rules. If you do some post-analysis and you're making some mistakes, you're going to develop some rules that are your personal rules that are going to help you from making repeated mistakes. So let's take this example and put it into some real numbers. So let's assume that 35% of your trades are winners and 65% of your trades are losers. Your average winner is 15%, your losers are 5%. So you're a 3-to-1 trader. And we're going to use that rule of thumb, max loss at 1% of your account value. So you might say, well, how much can I bet? What's the position size that I can put on for this trade? So in this example, I'll assume you have a $100,000 account and 1% of the account value is risking $1,000. So you back into position size, based on where your stop is going to be. So if you typically want to have a 10% position size of $10,000 in a position, looking at the math, we can only lose 1,000. So therefore my maximum stop loss is 10%. Now, if you're somebody who likes to be more aggressive and put on bigger sizes, a 25% position, your stop has to be tighter. You only can use a 4% stop in order to keep that risk controlled at $1,000. So building this plan around your numbers key. So again, taking this again, similar exercise, position size of 25,000. We want to make, our goal is to make a 20% return. We have a 3-to-1 ratio of gainers to losers. And our batting average in this example is a 400 batter, which would be great as a baseball player. Now, over a series of 10 trades, you play out the math. I'm putting on 25% size times 15% gainers, and I'm correct 4 out of 10 times. That's going to yield 15,000 in profit. My losers are losing 5% times the 25, and I've got 6 losers out of 10. I'm losing this much every 10 trades. But again, over the 10 trades, I'm profitable by $7,500. And you follow this 10 trade cycle, 26 trades is going to get you to that $20,000 goal. Now, this little table to the right, I think, is also another good way to look at it, because this is showing you, again, win rate. So in this case, this person is batting average of 400. So their win rate is 40%. Okay. Now, the average R, this person happens to be a 3-to-1 trader. Gains are 3 times their losses. So they have 3R. That's what their gains are. So 3R, 40% is their batting average. You can see this table is saying, if you do that over time, you will be profitable. So there's a table. If you're only successful 20%, 2 out of 10 trades with the 3-to-1 ratio, over time, you're going to be unprofitable. You don't have edge. So it's a good way to look at this. You should just make sure that your edge is going to be profitable.
Hey, John, can I ask a quick question?
Sure.
I realize you haven't broken for a question. The question I have for you is, okay, this is all really great stuff that everybody needs to be aware of as you're getting started. At what point in your trading career did you get to the point where you developed this to define your edge? Because you and I have gone through a similar type process, but I mean, you didn't just walk fresh out of the box and say, okay, yeah, this is what I need to do, right? How long did it take?
Actually, yeah, no, you're right. Because I mean, if you read Bill books 20 times, he doesn't really talk about this. He doesn't talk about risk management that much, other than, the cardinal rule: don't let losses get more than 7 to 8%. And like I mentioned, the 20% gainer is the 3-to-1 ratio. So he doesn't talk about it, though, the way we're showing here. But it's important. And, I didn't really fully grasp this until going to some advanced workshops. I went to Minervini's workshop. I took some advanced stuff, and those people focused more on this. And, a light bulb went off and said, yeah, this math stuff is really, really important. Because if your math doesn't work, you're never going to get there.
That's right.
And you're just never going to get there. And you know, it's funny because look at the win rate. Again, you can get an edge in a variety of ways. You can be only at 20% only correct 2 times out of 10. You just need to make 5R on your trades or more, and you
Right.
can get to profitability. So there's no, you have the choice of how you get there. But what's important is you have to track your stats. You
Right
have to
on.
really say, just because, I'm a 3-to-1 trader or somebody else is a 4-to-1 trader, what are you? And it's only when you really look at these numbers that your eyes will open.
Right on. So yeah, if you do have any questions, please drop it in the chat box. Gary, you just raised your hand. And so yeah, just drop your questions. And John, I won't interrupt until you're ready to answer questions again. Okay.
Yeah, this might be a good spot because I was going to go on to the next. Well, let me finish this slide here and then I'll open it up for questions before we go to the next trait.
Roger that.
Okay, so the holy grail of trading, and this is just building on this what I just talked about with risk management. The real holy grail is take your percentage of winning trades, multiply it by your average gain, and that's the numerator. The denominator is your losing trades percentage times your average loss. And you want that to be, that's called expectancy, and you want positive expectancy. There's going to be lots of trades over the course of a year, but here's an example. 40% of my trades are winners, and I make 30% on those trades. 60% of my trades are losers, and I lose 10%. You can see the ratio, it equals 2. What that means, it's a positive number. It's saying for every dollar risked, I'm going to make 2 over a series of trades. That's positive expectancy. If your trades look like this, I'm only right 20% of the time, and I only make 25% gainers. I lose 80% of the time, losing only 10%, but you'll see that you're never going to get there. You're below 1.63. So for every dollar you risk, you're losing 37 cents over a series of trades. So the numbers are really important. So I could stop there, Dennis, take some more on questions there because I'm going to go on to process next. So it's probably a good breaking point.
Okay. Yeah, guys. Now we can do the questions either one of two ways. You can type them in, which is a little bit slower, or you can just unmute yourself. I think you can unmute. Everybody can unmute themselves, and then just we'd take 3 or 4 or 5 questions right here. So, okay, we've got. Does anyone know of a program that can import your trade history, calculate your average win-loss in your batting average, as opposed to other methods that require you enter trades manually? Thanks.
Yeah, great question. I know there's other software out there and some of the brokers have it. I'll be honest, I do it by hand. And I do it by hand, but it's not the most efficient way to do it. But I do it every month, so it never gets too far ahead of me. You can't do this like say, well, I'll do all my trades for 6 months. You'll never do it. It's too overwhelming. So you can do it, but there's a lot of softwares out there that can do this for you.
Okay. Yeah, Yogesh offered a link there for trades viz that may have an idea. Ulrika, other people, old-fashioned Microsoft. Yeah, I do mine the same way you do, John. I enter my trades in a spreadsheet when I open the trade, and then when the trade is closed, because I close out parts of the position, three closes. I roll those into my closed spreadsheet. Ulrika, you have your hand up. Do you want to? You can talk if you would like to.
Oh, sorry, I was just typing. I was sort of getting confused between all the symbols. I was just wondering, John, do you have a recommendation for sticking with an edge versus starting to doubt what one's doing, and if one keeps getting stopped out, or that's
Yeah, I think what's important is tracking your trading, because you need to understand how you are performing. Like, some people don't know. I never tracked it. So just by tracking it, you say, hey, I'm a 2-to-1 trader, or I'm a 3-to-1 trader. Boy, my edge is upside down. That in itself, you can't really, what you can do is try to set goals. Like I think I mentioned, I'm generally a 350 hitter. That's not awesome, but I'm successful because I control my stops and I don't take big losses. So I can make the 350 hitter work. So it's important. I strive to say, I got to get to 400. I want to get to 400. So, I have that as a goal to try to get to 400. You can incrementally try to do that, but it comes out of your trading to determine what is your ratio and what is your edge. And you can always try to improve it, but it's not something someone can hand it to you and say, hey, Dennis, you're going to be a 5-to-1 trader. He might not have the psychology for being a 5-to-1 trader.
So yeah, that's absolutely awesome. Well, one question that I'll throw at to John that, and I probably know the answer to that. Well, no, I'm not going to, you can go there. Okay. When you first started and you were laying out, developing your system and developing what you were going to take and use from the can slim process. And I'm sure you did some back testing to originally establish what your batting average was, what your win-loss ratio was, so that you had an idea, and then went back and did the back testing, probably manually, to establish what you would be measuring, using that as a benchmark. And then did you modify that as you started trading so that you really then had real numbers rather than just back-tested numbers?
Yeah, I tracked things as I was going, and had a sense of my numbers. And what I actually did is, I always want to improve your numbers.
Right.
What it affected is I said, well, I've got to really look at my setups and say, look, when I'm looking at possibly taking a trade, where would I put my stop? That's logical.
Mm-hmm.
And say that's the trade. And what do I think I can get on the upside? 2R, 3R, 4R. And
Right.
starting to get picky to say, well, this trade's only a 2-to-1 trade, but I'm a 3-to-1 trader. This is not really fitting in my process. So I'm going to pass on this trade. And that's, when you're really starting to assess, I think everybody likes to buy stocks and there's lots and lots of tips and ideas, but what ones fit your risk reward? If you need to make 3-to-1, you've got to see on that chart, there's a way to make 3-to-1, or at least believe it can happen.
That's good. And so, hey, just a reminder, guys, please do not put questions and or links or any kind of stuff over in the question and answer. Put them in the chat box where everybody can see it. And that way it'll make our time together a little bit more efficient. So cool. Any more questions? Go ahead, Jake. Go ahead, Jake.
Unmute. Okay, there you go. Hey, John. So my question is always, which I've never really understood with some of Mark Minervini's stuff, is if you have a really consistent win rate, let's say of 50%, you're a 3-to-1 trader, and you can go long and short, you have setups for both. Why would you do starter or pilot positions instead of just doing like your normal full position?
Well, I think that comes down to your evaluation of the market.
Okay.
If you're in a correction, and then maybe the market's correcting, and you're saying, look, it's not an optimal environment, and I just want to put a few probes out there, you might go less. But if you're in an uptrend, then I would agree with you. You say, no, you put your position on. You're in an uptrend, you got a good setup, you put your position on as you normally do. Like I said, because you don't know which is going to be the winning horse.
Yeah, it seems like when I'll do like quarter-sized positions, and those are usually my best positions, and it's hard for me to get like fully invested initially, and it's kind of like by the time I'm kind of late to the game in the trend until I can get fully positioned. So that's where I have the problem.
Yeah, no, that's a great point though, because if 10% is your full size, you might say, well, I'm only comfortable saying I'll initiate at 5%. and I want to build it there with maybe 1 or 2 more purchases, as the trade develops. That's sometimes it's tricky. Like you said, sometimes stocks reverse, sometimes you get stopped out, sometimes they rocket ahead. So getting positioned is hard sometimes, and then this is where it comes down to your initial risk management. You don't want to say, well, I'll just plunge in at 10%, but I have to keep my stop like at a 2% stop because it's too tight. And you said, I can do that, but it's highly likely I'm going to get stopped out. So then you say, well, if you want to give yourself a 4% stop, a 6% stop, you've got to reduce the size to control your risk.
Okay. Yeah, one of the things I like to do, John, is, when the market gets in where they, suggest going to a lower level, lower level of being invested, I write it, it's written into my rules that's when I can basically, I still want to be trading and building positions. But at that point, when the probability of the market, being weak, my rules say go with half a position and then I build from there. But the important part I see is that make sure if you have some of these things that you want to be doing, such as taking a half position when the market's weak, write it into your rules so then you can go back and evaluate it later.
Yeah, it's a great exercise to, that initial buy has to be something that you can manage the risk. And I build positions too. If I don't know, if my target is to have a 10% position to 15% position, I'm never plunging in. But I might say I'm initiating with 5% and I'm going to build this out over time. And if it really works, I'll try to, keep building it. But you never know which one's going to, work out the best. So it's tough getting positioned. Like I'm going to show a slide a little later that talks about the challenge of getting positioned properly.
Right on. So, hey, Anil, who does the Friday Trade Your Way to Freedom podcast with me. Anil, did you have a question?
Yes, I do. For John, can you go back to your slide for expectancy? Yeah, I saw this in Minervini's book and I need to get straightened out. This ratio will never go negative. It's either more than 1 or less than 1, and more than 1 is desirable.
Right.
So I looked up the definitions on expectancy, and they're talking about the numerator minus the denominator as the definition of expectancy. Any thoughts?
There's all, I'm not sure which word definition you used and where you got it. And there's a lot of different definitions and ratios to evaluate tradings. This is the one I've used.
Okay.
Okay. Thanks, Neil. So any other questions, folks? And so, John, there was a question early on about when you were demonstrating about flipping the coin and all that kind of stuff. And somebody made a comment, well, if you only had 2 stocks, that would be very easy. And I think that was missing the point. The missing the point portion is that you basically employ your edge when you're choosing your stock that you're going that each trade stands on its own. And our edge defines the stock we're going to do, but then what the setup and trigger is to be able to get into that particular stock. But once we are in the stock, we lose control. The market's going to do what the market's going to do. And the only thing we have control over, the way I understand it, the way I look at it, we can control over when we enter and we can control when we exit. And that's where the importance of having a 5-10% stop loss, but also then having your 2R, 3R as your potential target comes in. Does that make sense?
Yes.
Okay.
I mean, that all makes very much sense. I
Okay.
mean, again, this is all probabilities. If you're taking trades and you think you can make three R to R, and you don't know. I mean, you could pick, like I said, you could pick 3 to 5 losers in a row. You don't control that. All it takes is one institutional trader to drop a block of stock and knock it down, and you get stopped out. You can't control that.
And then one last question before we move on into the next portion of this is, what did you personally do to get to the mindset that losing wasn't bad?
Well, I think you have to really understand, and you're going to lose a lot. Okay, it's an uncertain game, and all you can do is cut the losses short. And it's kind of a conditioning game. You say, as a human, we all like to be winners. We don't like to say I was wrong. But in trading, you're going to be wrong more than you're right. So the sooner you embrace that and say, okay, I got another one wrong, but I cut it short, I move on. It doesn't affect you over time. When you're a young trader, you're smashing the keyboard and throwing things around the apartment, and you get really upset and you get mad at the market, and that's emotion. And we're trying to, as you get more effective, you say, look, I'm just trying to execute my edge, and I'm going to take 7 losses out of every 10 stocks, but I keep it small. I move on, I take the loss, I process it, and we engage to keep trying to find our edge, take the trade. And again, over time, you have positive expectancy.
So when you say over time, that means like a month, right?
Long period of time too.
That was a kind of tongue in cheek.
Again, this is where it depends on your time frame. I'm a position trader, so the month means nothing to me. But if you're a swing trader, the month's important. If you're a day trader, it's even more important.
Yeah, exactly.
But as a position trader, a month doesn't mean anything to me.
Yeah. So, well, I basically take my time frame over a year. I mean, I want, because, and that's why people who kind of watch me trade, they go, Dennis, you had 5 losses in a row. Now, if I have 5 losses in a row, I do go back and double check and say, am I messing up? Am I doing something wrong? But that's the post-trade analysis portion. But I'm confident because my system has proven itself over and over and again for the last 13 years. I know what it should do. And so I don't get shook up by 5 losses in a row. My losses are small, similar to yours. And then I know that through the ebb and flow of the market, things will take back off. So
right.
John, kick off into your next section, man.
Okay, I'll try to move quicker. Okay, process. Winners have strong work ethics, and they're focused. They have routines, really important, daily and weekly routines. Winners, they study history, they conduct their own research, or they're really, really in tune with what the market history has done. And they accept that the market is always right, and our opinions don't mean much of anything. They accept that, and they're really hard workers. People that consistently lose, they always want shortcuts. They want to be, they're swayed by the news, the headlines. They're very unfocused. They tend to hop from strategy to strategy. And this is important because, if you are a can slim investor and you're trying can slim in a bear market and you're trying to buy breakouts, they're not going to work. Bill's got a whole page in his book. It says, don't be buying breakouts in a bear market. And you see people get really frustrated with that, saying the system doesn't work. And what they do is say, well, I'll go to trade options, or I'll go value strategy, or I will do day trading. And they just keep hopping, and they're not willing to stick with a methodology that does have edge. They basically get impatient, and they go through a lot of highs and lows emotionally. So what can we do with our process? Now, speculating in the market is a commitment. It's just something that's part of every day. At least for me, it is. And you try to say, I want to build routines to keep it very efficient. But it takes a lot of hard work. And this is a skill business. You have to have the business mindset. Gamblers might hit once, have a big trade, they get lucky. But eventually, that gambling mentality, they're going to get knocked out. You got to have a lot of mental toughness. And I think it goes to that point about saying, how do you get good at taking losses? That's tough on your psyche because you think you're a smart person. And you say, well, geez, I lost money on this trade. I lost money on that trade. I lost 3 in a row. You have to be mentally tough to say, that's normal. You're going to lose more than you're winning. Okay. It's going to test your psychology. It's going to test your resolve and your spirit. So it's like a boxing match. You're going to be able to take a punch or two because you're going to get kicked in the gut a few times trading. But on the offensive side, when you get the odds in your favor and you have a big winning trade, you can land a haymaker. So you got to protect your account. You got to play defense first, and because you don't want to get knocked out of the game. You blow up the account, then you can't play anymore. So it is hard. And again, we're not talking about charts today. We're not talking about trade setups. We're talking about the mental game. And it's very difficult at times, and it can really, really affect you. That's why it's important to try and stay balanced, and we're going to talk about that in a bit. So, winners, if you looked at a winner's equity curve, they have consistent profitability, and I'll say controlled drawdowns. There's going to be drawdowns. Okay. And I mentioned, 10 to 15%, I think, is a workable range. You get any more than that, I think it gets really difficult to overcome, and it becomes more difficult on your psychology. Now, losers, it's very inconsistent. It's all over the place. They're going to have huge spikes when they make some incredible wins, but then they're going to have big drawdowns. It's just a real roller coaster. And the important point to make is, this type of gambling, you have a pretty good possibility of getting knocked out of the game. So we want to protect our capital, the mental capital, as well as the physical capital. We want to have a trading plan. We've talked about that, how much we're going to risk, how much you're going to risk per trade. So I'm not going to belabor this one. So here are some things we can do. Here's 4 practices we're going to cover relative to process, routines, scenarios, adding to your process through elimination and balance. So number 1 is building routines that become automatic habits. Time is a very, very precious commodity. We have family, children, your primary job, social media is constantly on our phones. It's really important to establish a daily routine that's efficient and works for you, a weekly routine, and then also have a special project routine. Generally, when the market's in a correction or we're in a bear market like we were in 2022, I always have a few research projects. Like in 2022, I said, now's the time to do those research projects because I'm not going to be as active. So you can spend some time in a different way. Now, in your building routines, again, you got to build them in a way that they become habits automatically in your routine. What do you do? And everybody does this differently, so you have to find what works for you. But things I would have you consider is, we want to be in sync with the market. So you say, I got to know what's going on with the general market. And maybe I want to do some research or be aware of history and study model book stocks. And ask yourself, are you going to do these things yourself? Are you going to outsource them? And if you have a trading group, a bunch of trading buddies, maybe we could do this together, share information to lighten the load. So there's certainly a segment of market analysis, watch lists, and actionable ideas. Again, you're going to do that yourself. Some people are really into screening, and they spend, the weekend screening and generate watch lists, and they come up with actionable ideas. Personally, I'm not a big screener. I actually tend to outsource some of this. Now, also, when you're doing screening, maybe you break it up. You got a group of 3 or 4 people, you can break it up, share ideas. Education and post-analysis. Are you doing it yourself? You're doing it as a group? Think about how you do that. And how do you find out more about a company you're interested in? Fundamentally, maybe it's the sector, maybe it's semiconductors, or what are the trends going on in cybersecurity? These are all just different components. But I think ask yourself, who's going to do this? Because you only have so much time. And to do all of these partially or skip some of these, you might have some holes in your system. So you have to think about how you spend your time, and then you're going to tackle how you can make these habits. Like I said, maybe Sunday nights you meet with your group and you share watch lists. Maybe general market analysis, I'll plug my own Friday general market analysis video. Say, look, I like the way John analyzes the market. I'm going to watch his video. I think he knows what he's talking about. Or you watch Webby's videos, or somebody that you think, I want to outsource that. I want to hear from somebody else. Or maybe you do it yourself because you say, I really want to do my analysis and I don't want to listen to other people. But consciously think it through. And a great book on how do you make some of these things habits and routines is this Power of Habit book. So I would encourage you to read that. It talks about how you can ingrain a habit to become automatic. Now back to scenario planning. I'm going to talk a little bit more about on the defensive side. I always think the planning unit, we should always start with a defensive plan before your offensive plan. And we want to be aware of drawdowns, portfolio risk, and individual risk. And I kind of look at this as a kind of a birthday cake. At the bottom of the birthday cake is portfolio risk. And this is what I mentioned earlier. If all my positions get stopped out based on where I've placed those stops, how much portfolio is going to get hit? I want to know that number, particularly as positions start to work. And you have to say, well, where am I moving my stop up? How much open risk do I have? And cumulative risk. So I want to know that. We also want to be prepared because growth stocks are going to correct, 2 to 3 times the market indices. So when the NASDAQ corrects 8%, your stocks could be off 20 to 25%. And that's considered normal. So you have to say, I have to anticipate that because we are trading growth stocks. Portfolio drawdowns, I mentioned, 10 to 15% max, I think is a pretty good to stay within equity highs. And also, I think this is a couple of portfolio management rules of thumb. If you are on margin, if your account comes off 8% off the highs, I would immediately get off margin. If you're 10% off the highs, you should generally be raising some cash. And if you're 15% high, you might even go to 100% cash in trying to control the portfolio drawdown. So just a couple of guides there. So we have portfolio risk. The second layer of the cake is sector risk. And sometimes we neglect this. So we want to know how much are we exposed to, and I'll suggest semiconductors. If your portfolio is 6 stocks, and 5 of them are semiconductor stocks, that's a lot of exposure. And if that sector gets hit, you could have some pretty sharp drawdowns. So, as a guide, a general guide, I don't like to see sector risk more than 20 to 30% of my portfolio because normal pullbacks can happen in a sector, easily be 10% corrections. We talked about the indices correcting. So, if you're really concentrated and you have 100,000 portfolio, let's say you have 10 names, but you got 5 of those names in the semiconductors, so 50,000 is in the semiconductors, and that semiconductor starts to sell off or rotation and it corrects 15%, your portfolio could be down 7.5% in one day. So again, being aware and playing defense first, saying it's fine when semiconductors are going up, but be careful about not managing the risk, saying, what's my exposure if things go south and what controls am I using to manage that? And the third thing we have is individual trade risk, which we're probably all the most familiar with. So, we want to be looking at the charts. We want to set our expectations. So every individual chart, that you have position in, you should be looking at it and saying, when the market is closed, after the market is when you should be looking at your positions and saying, what's my plan for that position if things go in my direction offensively? And what am I going to do defensively if things go against me? And what would be my plan, or what would be my hold plan? So you need to really ask that question for every stock you own every night, and just say, I've got a plan for these stocks. Do I need to raise my stop? Do I need to set a target? Am I getting close to taking 3R, 4R? So a written plan will also help you tremendously with trying to keep emotions out of that and do it when the market is closed to eliminate, dampen your emotions. So these mental rehearsals are important because you're actually trying to emotionally rehearse a trade. If you're looking at sector risk and you're saying, wow, I didn't know I could lose 7% of my portfolio, you said, I got to do something about that. I have to either tighten my stops, or I have to take some profits, rotate some money. So the emotional rehearsal is important. I know sometimes we get caught in FOMO when you see a sector or even an individual stock that's really running and you're saying, oh, I can't believe I missed NVIDIA. It's running, it's running. But you know deep down that it's extended. One of the things, this is just a hack. You could buy, it's extended. You could buy a really, really tiny amount just to satisfy that urge. And I mean a tiny amount, like 5 shares, it's tiny, just to satisfy that. Believe it or not, just buying a tiny, tiny amount, it's like, okay, at least I bought a little something, and you're not going to be, really an emotional wreck. So that's just a hack that I use. You probably all have your own little hacks because FOMO can be real. So practice number 3 is to add to your process by elimination. So it's really, once you have your process, you have your routines, you have your setups, it's not about adding more. It's not about saying, hey, can I add some more indicators on these charts? Hey, instead of 2 monitors, I want 4 monitors so I can look at more charts. I'm going to do more back testing. I'm going to start subscribing to, listening to more people because I just love listening to the market. I think it's important that, to be a winner, you need to have a strong filter. You really should only be letting in things that are complementary to your system and your edge. And you have to ask yourself, is more indicators, the ones I'm considering, is that going to complement my system and edge? If it isn't, then I wouldn't do it. You really have to have courage and confidence. And this is where you have to have confidence in your edge. Over time, most people get discouraged after 1 or 2 months and they hop from strategy to strategy. You're never going to really get anywhere. You're not going to be good at anything because you're never going to learn a strategy deep enough to get really, really good at executing that strategy. So, it can be very, very distracting and confusing when you lose your confidence trading. So again, filter out anything that doesn't fit in your system. And that's not easy to do sometimes. When we've got YouTube and Twitter and podcasts, and there's so much out here, I really encourage you to say, I got to have a filter. I put all that stuff through the filter and I say, does it help me with my methodology, my setups, my market assessment, my edge, and my risk controls? So if I actually say, eliminate things, don't add things once you have a good, sound process. Now, I'll also just give an editorial. People love free stuff, and they constantly fall for hype. So I would be very, very discerning about signing up for free stuff. Just because it's free doesn't mean, again, if it's free, it could just be noise. That's going to basically take away your focus of your system, your setups, and your edge. So just because it's free doesn't mean you have to watch it, see it, consume it. Really, really have a filter. Consistent winners, they know what they're doing, they have confidence in it, and they don't let much else in. They really don't let much in. Even really successful people, they won't do it. There's no need to do it because they know that their edge over time works. Number 4 is balance. And here's just a couple little tips. Avoid looking at your account value, especially intraday. I generally only look at my account value at the end of the week. I never look at it really in intraday. There's nothing to be gained intraday looking at your account value if you have stops in place and targets set. Watching your account go red or green only raises your emotions. And that is absolutely counter towards keeping a level head and maintaining your trade plan. When you see green on your screen and your stocks are all doing really well, you're going to feel invincible. And you're probably stray from your trade plan saying, hey, I'm up green, I'm really doing well for the day, I'm going to put on 2 more trades today. And they really weren't planned trades. You're just feeling invincible. Counter to that, if you see a lot of red on your screen, it's a down day, you're going to get so scared emotionally, you're going to say, I didn't hit my stop, but I'm going to sell it anyways. I'm going to choke off the trade. I'm not going to follow my trade plan. I'm going to abandon the trade plan. And you're going to get really fearful because you're going to see, your account is down. So don't do this. There's nothing good to come out of this. And you want to stay balanced. And for those of you that put on larger positions, and if you're using margin, it's going to be even more emotional initially. If you're young at trading, you've only been trading a few years, and you're trying to put on big positions with margin, you're going to be on the roller coaster. And it's going to be very, very difficult for you to keep a level head. Now, as you gain experience and you get comfortable with larger positions and comfortable with margins, you'll handle it because you've conditioned yourself from years of trading through bull cycles, bear cycles. You'll get more comfortable, but it's a process of building up your muscles. If I tell somebody, hey, go lift these dumbbells and they're 500 pounds, that's not the first thing you lift. You have to kind of condition yourself, lifting weights with smaller weights, and then you build up to larger weights. Balance. So define success differently. Did I follow my trade plan for the day? If you decided you had triggers for trades and you had stops in place, did you follow them? Did you not abandon and audible those trades? If you held to your plan and it played out, that's a successful day. A lot of people don't follow their plan. They get caught up in the day emotionally. Did I follow my rules? So if you have discipline, you've got some good rules, you have an edge, and you can execute that edge, it'll lead to the money. It'll lead to the money. But you've got to really be disciplined and balanced. And that's why what we're talking about to being a winner, this isn't about the best setups. This is about balance, maintaining your balance through red days as well as through big green days. And you can even reward yourself if you take a loss, but you followed your rules and you followed your trade plan. You did well. You should pat yourself on the back. This is part of conditioning yourself. We talked about how do you deal with all these losses. If you take a loss because you got stopped out and followed your rules, you need to reward yourself. That's a good thing. You're conditioning yourself to take a loss, let it roll off your back, and move on to the next trade. So as Dennis mentioned earlier, all the trades are completely independent of each other. Yes, we could have clusterings. We could have 3, 4, 5, 10 trades in a row, but they're all independent. Revenge trading is really emotional. And one of the most dangerous thing about revenge trading, revenge trading is if you take a loss, maybe your stock gapped down and you took a bigger loss than maybe you had and blew right through your stop. You say, my stop was at 8%, thing gapped down 15%, and I took a 15% loss. What a common mistake is when you take that gap down 15% loss, their brain says, I want to get it back as soon as possible. And that can be the most devastating, dangerous thing is, well, tomorrow I'm taking a big trade and I'm going to get it back. I'm going to get back those losses. That's not a good strategy. That's emotions that are talking. Okay. You have to actually accept the fact that if you take a 15% loss, you have to just simply execute your edge and gradually get it back. You can't say the next trade I'm going to double up and take more risks because I want to get it back quickly. So it's really an emotional thing. It can be really, really, actually taking revenge trades can actually dig your hole deeper, faster, and then you're going to be in that situation where your account is down 30, 40%. The market loves those big egos. It loves overconfidence, especially the recency effect. If you've strung together 3 or 4 big winners, you'll think you're invincible, but you're not. Winning trades doesn't mean you load up on the next trades. You just try to repeat your edge. So this conditioning of your mindset is really through repetition. And it's not normal. Some of the things that we're doing in trading are not normal. Buying new highs is not what they teach you in school. They always say buy low and sell high. Well, Can Slim buys high and sells higher. That's not normal. Taking losses repeatedly is not something we're conditioned to do. So you really have to reframe your mindset. And reading Bill's book is good at least once a year. I think studying the big winning stocks to understand what's normal action from abnormal action is really important. Post analysis. Most people make excuses. They really don't do this. They really don't do it. And it's so important to find repeated mistakes, because then you can create rules to help you avoid those. I'll pause there for a moment, Dennis, on that section there, our process. Any questions?
Okay, guys, any questions out there? So some people were asking about the recording. The recording will be posted in a couple of days. Once I get that up, I provided you my email address, and also if you want to register at autopilottrading.com, you will go on to the mailing list and you'll get updated with not only the videos, but also invites to other sessions, like the session we do on Friday that I do with Neil Parikh, the IBD organizer from Delaware. Let's see. Any questions? Come on. John, it doesn't look like.
Okay.
Okay.
Well, we'll just keep rolling. Patience.
Let's keep going.
Yeah, let's keep rolling because still got stuff to cover, and want to make sure we get to it. So again, winners, what it takes to be a winner. Patience. You got to wait to get the market to give you feedback. Incremental approach to increasing exposure levels. We don't plunge into the market. Winners don't plunge into the market. We cut losing trades. We move on. It's all part of the game. Where people that lose consistently, again, I just mentioned this. When you lose in a trade, they feel the urge. They have to get it back quickly, which is really dangerous. That's called forcing the next trade. And if we're in a bad correction or a bear market and you're forcing trades, you are going to dig a hole really quickly. And if you plunge back into the market and take abnormally large size because you say, I want to make back, you're going to get in a lot of trouble. So patience. Now, winners in the market are very impatient with losing positions. When you put on a trade and you've got the setup that you want, that has the edge that you want, your expectation is it should work. Okay, it should work. And if it's not working, you want to be impatient. To get stopped out, okay, it gets stopped out. It didn't work. We're going to move on. Now, you get a winner, you get ahead, and you get some cushion, then we want to be very patient with the trade. As a position trader, if I get good cushion in a winning position, I'm going to sit. I want that trade to give it time, give it some room to work. So, we don't know trading is loser, 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 winner. 6 losers, a winner. You're going to have a lot of losing trades. But if we can get a winning trade, we don't want to cut that winner short because it makes up for all these little losers. So there's times when you're impatient and times when you're patient. Perseverance. It's important to recognize that overnight riches, for the most part, don't occur in your first couple of years of trading. We all go through the school of Wall Street, and we're all going to make mistakes. We won't cut losses. We'll take tips. We'll make a lot of mistakes. It's, generally, you need to get through a complete bull bear cycle, and usually a couple of those to really refine reducing your mistakes. So you got to persevere. You're going to make mistakes, but the faster you are as a learner, the better off you'll be. Now, 2020 was a great example versus 2022. A lot of young traders and experienced traders made a lot of money in 2020. It was great. It was a great bull market. The question is, were you able to keep it? Were you smart enough? Did you have sell rules? Did you get out of the market in 2022 and not keep trading? Many people I know who did really well in 20, they kept trying to trade throughout the first half of 2022, and they gave back way more than they should have. They were just trying to force it. So you got to be perseverant. You got to be patient. Trading has a learning curve. And I mentioned before, you got to have some mental grit, some toughness. There's going to be some good days and be a lot of bad days too. You've got to accept there's going to be both, and you got to be patient. So let's look at a couple things, some potentially some good practices. When we want to have a little patience or a lot. We'll talk again about defense and then avoid jumping the gun. So as mentioned before, pros, winners, they go broke taking small profits. So I mentioned before, when a pro has a losing position, they have very little patience for it. They will cut it. If it's not working, it's not meeting their expectation. When you had the setup and it doesn't work, they're going to cut it. They're not going to mess around. But if they have the big position, they start building a position, they have a lot of patience. And we know that model book stocks, tend to take 12 to 24 months for the big move, to go up 100, 200, 300%. So you have to sit. Now that means sitting, you're going to have to sit through some bases. So that can be very, very difficult. But if you're a position trader, you've got to really accept, if you want to go for the big money in a model book stock, there's a certain amount of patience. Now, amateurs, the people that consistently lose, they go broke primarily because they take too much risk and they take larger losses than they should. Losses that start out at 10%, they get caught, they become 20%, then they freeze up and they become 30%, and then before you know it, they're in a lot of trouble. Now, if you look at trading as playing Texas Hold'em, when you're in Texas Hold'em, every day, in Texas Hold'em, they're dealing you a card. You have the flop, then you have the turn, and then you have the river. So you're seeing cards incrementally. And it's no different really in the stock market. Every day the stock trades, a new bar or candle gets printed on that chart, you're getting more information. A new card has been dealt in that particular chart. Now, I think it was Bill who said, you can mess up and misplay a lot of hands of poker or trades as long as you don't make a huge bet and go bust. You have to stay in the game. So you can misplay a bunch of hands and still hang around with your account and correct those going forward. But if you take excessive risk, you could lose it all. So we also want to know that, when the cards are in our favor and you got pocket fours and the flop was a 4 and you get a 4 on the river, you also got to recognize those positions where you're going to press your advantage and get more money into the pot and into your position when you're trading. So think about it every day. A new candle or a new bar on that chart is like a new card coming out of the deck. So, trading, over the course of a year, there usually is a lot of meaningless trades. When you look back and say, okay, I made 100 trades for the year or 200 trades for the year, there's going to be a whole bunch of meaningless trades, lots and lots of little losses. Say I got a lot of losses between 3 and 5%, they're meaningless. And usually there's going to be a few big gems. 1 or 2 trades, if you get sized right, they're going to make or break your year. So it's just the nature of the game. Lots of little small losses, but if we get positioned properly, we can make a couple of big winners. So we also got to be very aware of the conditions. And if the conditions are if we're in a bull market, we're making higher highs and the breadth of the market is strong, we want to be aggressive. If the market is not showing good breadth, the market is correcting, we have to recognize that and say it's a go slow environment, meaning we should not be initiating a lot of new positions when the market is correcting and it's not looking very good and favorable. But if it is strong market, you can be more aggressive with adding to positions. So in a way, there's going to be a lot of small losses, a lot of defense cutting all those small losses, but we want home runs, those 1 or 2 big trades that really are home runs as a position trader. So the patience and sitting is important. And many times, we go on the sidelines, we go to cash. And it's really amazing when you go to cash, what it does for your mindset. When you're in cash, you really can actually think clearly. You have no bias when you're in cash. When you're flat and you have no positions, it's amazing how clearly you can see things. The reality is when you have positions on, you've got money at risk, it's emotional. And you want to really have a system that dampens those emotions. And sometimes getting to the sidelines is very, very important. It'll help you think clearly when you'll have no bias. So this triangle is something I shared on my interview with Richard Moglen. My goal as a position trader is to get all three of these sides of the triangle. I want to hopefully be in one of the big leading stocks of the cycle. I want to have a large position size that I built up over time, and I want to have good average cost. I want to build a large position, but I got to do it in a responsible way where I have good cushion and a good average cost. Raising your average cost too fast, and you'll be under a lot of pressure if the market corrects. Now, getting all three sides of this triangle together at the same time is not easy at all. You might be in the wrong stock. You got a large position, but you're not in the big leader. Or you might say, I got the big leader, I got NVIDIA, but I have a 2% position. So getting it all correct is not easy. Now, when we put on our initial positions, we really have three objectives. We always want to protect the downside with our initial stop, and you calculate that stop based on your position size and your risk level. So we want to protect that. And then if the trade starts working, we still want to play defense and move that stop up to break even. I typically won't move a stop up to break even until it's at least 8% profitable as a rule of thumb. But I have a short video on that in my YouTube channel. And then after that, if you get a position that really starts to work, and it's a multiple of your risk, either if you're executing your edge at 3 or 4 times risk, you might take off half the position, third of the position, or maybe you take off all the position, depending on your strategies. But if you get a big winner, you have to be in kind of profit protection mode. You need to know where your line in the sand is going to be. If the position starts to break down and shows sell signals, you have to be unbiased and recognize the sell signals that maybe it's time to take your profits. We don't want a round trip if we can avoid it. And when you're looking for home runs, big winning trades, you actually have to play more defense. So let's look at this a little closer, what I mean by that. So if we've got a big winning trade going, we got to protect it. And this is mindset. If I have a big winning trade that I think I got a big winner and I want to play it out for a year or two, I want to protect that trade. Well, how do I protect the trade? Well, I have to play more defense. And that means my other positions have got to be managed very, very closely because I don't want them to erode my big winner. So we work extra hard to control risk. We got to keep our losses very small on other trades. So if I have gains that are building, it's my money, it's not house money. So if I have a big winning trade, I absolutely have got to resist this impulse for any sort of gambling trades. I don't want to erode my big winning trade by doing a bunch of bonehead things. I don't want to take big bets before earnings on different stocks when I have no cushion. That's a bonehead thing to do. I don't want to be in speculative stocks like biotechs with no earnings and sales, thinly traded stocks that have no quality sponsorships under $10 a share. I don't want to be in these because if one of them goes down 50%, I'm going to muck up my portfolio. So I don't want to wander outside my strategy of setups. I want to stay with my setups. So it's important to not muck up the big trade by screwing around with a bunch of other trades that are gambling trades. So here's another way to look at it graphically, because I am an architect. So let's assume you have NVIDIA and you got a big position. You say, wow, the profits are coming right into my bucket, and I'm trying to get this bucket of water filled to the top. And I got profits coming in from NVIDIA hand over fist. But unfortunately, in the bottom of this bucket, you got these losers. You're taking crazy trades. You got CRM, and these trades are gapping down. You're not cutting your losses. You have leaks in the bottom of the bucket. You're trying to get that equity curve to get to the top, but it never gets there because you got all these leaks in the bucket. That's what I'm talking about when I'm talking about you got to protect the big winner. Okay, so that's what I mean by that. Think defense first, even when you have a big winner that's doing well for you. Practice 3 is don't jump the gun. So you don't have to be the first into the market to finish in first place and finish first in the race. Now, jumping the gun is, you could say that's kind of like buying a breakout maybe before it occurs. Why do we do this? We see a pattern, we see a consolidation or a coil, but we feel this, we're trying to say, well, I want to buy deep in the base, or I want to get in early. I think, why do we do it? And we've all done it, including myself. We got this fear that we're going to miss out, and we're missing out on what? Well, I want the maximum amount of gain. I want to get in early. I want to get the lowest cost possible because I want the maximum amount of gain. And that's a fear. Or I fear that I'm taking too much risk by buying the breakout. If breakouts are failing, if the breakout fails, I'll have a smaller loss because I bought deeper down in the base. So this is all about fear and greed working. And that's why we all tend to have a tendency to say, well, I want to jump the gun. I want to get in early. But actually, you're lowering your odds by buying early. You don't know if that stock is ever going to break out. It might stay in the range and just keep going sideways. It might break down. It might break out. You just don't know. Now, sometimes it works. And I'm not discouraging from buying early in a base. I do it when I have a strategy, a specific setup that I'm looking for. I will take a shot at it. But I think in general, don't jump the gun unless you have a defined setup that you can attribute it to. Don't just buy early because you want to buy early. Do it when you have some edge. Now, if the market conditions are showing that breakouts are not working, and that's why you're trying to jump the gun early, I would suggest you just don't take the trade, because the general market is giving you feedback that breakouts are not working, which probably means your early buy is also got odds stacked against you if we're in a correction or we're in a bear market. If the market does favor breakouts or we're in a bull leg, set your buy stop, buy the breakout and let it trigger, and just know when you'll get out. If we're in a good, strong market, breakouts work in strong markets. So when you start to see a series of breakouts not working, that's giving you feedback that maybe market conditions are changing. So this is another one of the few charts. I think this is only the second chart I've shown in the presentation. Is Paylocity. This is just, again, this idea of, we downtrend line the base. We all feel compelled. I want to get in early. The standard breakout might be up here. We might want to buy early. And I'm just showing this example. You got in early, but it doesn't guarantee it's going to work. It could flop over. As long as you're controlling risk tightly, you might think it's worth give it a shot. If you've got a setup that you have edge and you successfully traded before. Okay, the last is going to be confidence. Dennis, do you have any questions before we move on, or do you want to take a bio break?
Yeah. Does anybody need a comfort break? We'll give about 3 minutes to go, charge your coffee or get rid of some coffee. And then we'll be back after that. We've got a couple of questions that we'll ask. Let me ask these questions first, John, and then let the folks go. One is when you do have a stock that turns out to be a big winner, okay, let's say you're up 25, 30%. Now, have you, like Bill would basically buy more of the shares to let it continue to run up, right? So if you're, practicing good, control of the position sizing and all that kind of stuff, at some point you could be having a large portion of your portfolio or your capital dedicated to one position if it's a huge winner. How, do you gauge that at all?
Well, that is a risk tolerance level for each individual investor.
Okay.
You know, when I talk about large positions, I talked about, you know, kind of this analogy of lifting weights. You know, um, you have to build up your trading experience to build larger positions. You know,
Right.
sometimes, 10% position might be comfortable for some people. Other people say I'm comfortable with 20% positions. Some people are comfortable with 40% positions. And some people, who knows, they might say I'm comfortable with 80 to 100% positions. Bill on occasion, I guess, was 200% leveraged. So
Yeah. Yeah.
that's not for everybody, and I wouldn't recommend it. But
Yeah.
but you have to know where you start to feel uncomfortable, and your psychology. And so to me, it's something you build over time.
Okay.
To say, if I'm comfortable with a 10 to 15% position, and I've gotten comfortable about how I manage that, and I can accept intraday volatility, accepting, what that means, then maybe you say, I want to try and get to a 20% position if you're comfortable at 15. But you have to decide what's your comfort level, and there's no rule to that.
Okay.
And I think also, when you mentioned also about larger positions, I think you mentioned if you have gains of 20, 30%. I have a chart that I showed in one of my weekly videos that actually was how much cushion you need to have to survive a base. And I don't have it in front of me, but the rule of thumb was, if you don't have 40% cushion in a stock, and you anticipate that the market's correcting and it probably will go into a base, and your stock, being a growth stock, might come down 20 to 25%. I don't have the chart in front of me, but if you don't have a 40% position, your gains go back down to like 8% and a 20% correction. It's really devastating. And you said, geez, I thought I had a lot of cushion, but you really didn't. And what happens is people get fearful and they say, oh, I got to sell out. And they basically blew their trade plan because they really didn't understand what it meant, how much cushion they needed to sit through a base.
So the follow-on question to that, real quick, John, is, let's say you were up 50% and you notice that the stock is going into a base. Do you carry a trailing stop at 20 or 25% in a situation like that?
Yeah, for me, it would depend on what my current size is. Like, if I have let's say I have a 10% position in that situation, which I'm comfortable with. I want to see the chart, because I want to look at the chart. I want to say, where's the support on the chart? What would be normal for a correction in a bull market? And I want to look at that and put it on the chart. Say, where's that line? Where's this line? I also, if it's coming up to earnings, I'll say, what's a 20% gap down look like?
Right.
And I'll weigh all these factors to say, am I comfortable with that kind of drawdown? At a 10% position size, I'm probably okay with the drawdown. Now, if my position was 25%, I might say, I'm not sure I'm comfortable with that.
Right on. Because I know that I've run into many people who kind of like threw their stops out the door, and out the window, and just just the most foolish thing I've ever seen. The other question is, does it make sense to buy puts to protect a big winning trade? And so I know some people hedge their positions to protect a big winning trade. And I know I have my opinion and my beliefs on that, but what do you ever use options to hedge your positions?
Yes, I have used puts to hedge positions. I'm going to say with mixed success. One time I had puts and the stock basically stayed where it was, so the puts just expired worthless. They weren't you couldn't exercise them, and they didn't help. So that can happen. So that can backfire. So I've hedged positions with puts before. I've also, as you're building a position, you've got 3 or 4 or 5 buys, I might scale off the last couple of buys to cushion for a pullback, which essentially is lowering my average cost to give me confidence to hold.
Right.
And then if things go my way and we come out of that base, then I'm going to be, getting back in, or at least building the position back up. And that's actually just the way I've been handling I'm in CrowdStrike, and that's my largest position. And, CrowdStrike, it had some really bad action before its earnings. They had 3 or 4 days in a row where it was
Yep.
really coming down. And I was just saying, boy, this is really bad action before earnings. So I took off my last 2 buys that I'd made for small losses. But it lowered my average cost quite a bit. So I said, I can hold through the earnings because I calculated where the potential gap down would be, and I was comfortable with it. And
Okay.
now I was fortunate that, the stock did well after earnings. And so I bought back what I had ditched. And, that's one way to handle it, is to take some stock off your high price stock, but you never want to dislodge your low cost stock. You don't
Yeah.
want to, you work so hard to get it. Don't throw it out the window for nothing.
Yeah. So one of the questions, how are you outsourcing your trade ideas? I don't think
When
you
I say
do.
outsource,
Yeah, go ahead.
I think, if you find a newsletter or a trading service and you say, boy, they are really good and they do screens, or they give me watch lists, or they do fundamental research. You find somebody you like and comfortable and you say, I got to pay for this. That's what I do. I have a couple of newsletters that I use that save me time. One of them that some of you may have heard of is called the Cabot Top 10 Trader. And it's the Cabot Wealth Group. And
Right.
it's a weekly newsletter that comes out every Monday. And what's great about it is it's 10 stocks in a week, and it has a small synopsis of the fundamental story and a little bit about the chart. And it's a great way for me to stay on top of the story of lots and lots of stocks. And it saves me time. So I forget what it costs. It costs, I don't know, $300 or $400 a year. To me, it's worth every penny, because I guess that I'm not a big screener. But just by staying very active in the market, I don't miss much because I'm always looking at stuff
Yeah.
and getting a newsletter or two. So I say that's outsourcing. That's
Yeah.
outsourcing.
Yeah, exactly. Well, I mean, that's, I never looked at, because I mean, you do provide some of your members who subscribe to you, you provide them the stocks you're trading, right?
I will be at the premium level membership when I launch.
Okay. And I do that now. And so, and we put out a sorted list of the best of the IBD watch list that I go through and hack through, and with some help of some of our members, to cut it down to like 20 stocks per week, 20, 25 stocks per week. And then we come up with our top 5. And so that works really well. Hey, one of the questions here, I completely agree. He says, I found that hedging makes me lose focus on directional trades. And John's hit on it a little bit, is that if something's distracting you from your primary position, then I'll just give you a bit of a psychological advice. Stop doing it. Another question from Phil: if you have a cover call as a hedge or partial hedge of a position, what would be a good rule of thumb for the stop loss that you would put in on that option? Hypothetically, Apple today.
I use options very infrequently, and when I do use them, I keep it very simple. I either I'll buy a call, or I buy a put. I try to keep it really simple. So covered calls and spreads and things like I'm not the person to talk to.
Okay, good. So, well, John, about approximately confidence, how long will that be?
Let's see. That segment is about 20 minutes.
Okay. Well, guys, let's take a real quick 3 minutes on, let's take about 3 minutes, and we will come back at 7 minutes before the top of the hour. I'll be right back. Thanks, John. And John, if you are still there, I hope you are.
I am.
Okay, yeah, just if you could just throw your contact information, how people are going to reach out to you down in the chat box, that would be good. I put in your YouTube channel ID, but you want to just throw that in there because I know you're going to also cover that at one of your final slides.
Yes, let me put that in.
No, Jim, the meeting is still going on. We're just taking a little bit of a 3-minute break. We'll be popping back in at 7 minutes. In another minute, we'll be back online. Okay, guys, we should be ready to get back and get going. It is 7 minutes till the top of the hour. John said he has about another 20 minutes or so to go. And remember to keep putting in your questions so we can be able to address those. I have put in my email address also. And again, if you want to, get on my mailing list, and I will basically be sending you out invitations to future Bay Area Moneymaker meetings, and also notifications of some of the live sessions that we do over on the YouTube channel, Market Tech Talk. John, whenever you're ready.
Okay, I'll try to move it along here. I'll try to keep it as swift as we can. All right, so we're going to talk about confidence. Important topic. So, winners don't connect their confidence with their trading results. Now, losers completely connect their confidence and their self-image to their trading results. So let's delve into this. Now, confidence is the ability to make decisions without hesitation. We want to be independent. We want to ignore opinions in the news. We got to get comfortable with ambiguity. The market is all about uncertainty and ambiguity. It is speculation, and we're making a bet. So we have to get comfortable that there's a lot of uncertainty of what could happen. So in order to do that, we're really relying, you have to have a methodology. You have to have some rules, and you concentrate on perfecting your strategy, executing your strategy. If you lose confidence, you lack confidence in what you're doing, you're never going to have the nerve to follow a trading plan. So it's so important that you could know what to do. You got to know what to do. Then you have to execute your plan and then accept the results. There's a lot of unskilled traders that have a tremendous amount of confidence. And then there are some very skilled traders that lack confidence. Now, there's something called the Dunning-Kruger effect. This is a study done by Cornell in 1999.
John, hold on just a second. Excuse me. Did you move your mic from before? It just sounds a little bit different.
No, is it okay?
Okay, yeah, okay. No, it just sounded a little bit more warbly or something. But and so I thought maybe you had moved it, but continue on. Sorry about that.
No, I'm sorry. The mic, is it better now? Is it better, Dennis?
Yes, it is.
Okay. So this study done in 1999 tested people on logic and grammar and sense of humor. And those in the 12th percentile self-rated themselves to be as high as the 62nd percentile. And the whole study was about individuals mistakenly believing that their expertise and their experience and skills in one particular area were transferable to another. So this is the Dunning-Kruger chart with confidence levels and your knowledge of a particular field. You know, low knowledge to high knowledge, and then confidence. And they had this chart which says, you know, I know everything. I have super high confidence. I think I know everything. Gradually, people come down to think, well, there's more to this than I thought. Geez, I'm never going to get this. And when we look at that, you know, this is another way of looking at it with different labels. But this is basically your unskilled trader with lots of confidence. They really don't know a lot about trading. They don't have a lot of experience yet, but they really believe that they're going to knock it out of the park. And then you have people that are very skilled, and they have high confidence, or so they lack the confidence, even though they're very, very competent. So, you know, we mentioned earlier, you got to have a methodology and strategy that works with your psychology. This style hopping can be very, very slow your progress. You know, if you say, oh, 1 minute I'm a canceling breakout trader, and then later on say, no, I trade levered ETFs. No, I'm going to try pullback setups, but I'm going to use intraday charts. And, you know, you can really get yourself twisted into knots knowing a little bit about a lot of topics, but never really getting good at any of them. So it starts with a plan. Confidence is really starting with your plan. And I've hit this a couple times. You got to have a plan for offense, and you got to have a plan for defense. So winners are balanced, and we talked about balance. They know their strategy, and they can make decisions around that strategy based on their rules and their risk management. The people that, you know, lack confidence, they vacillate on decisions, they make emotional decisions, and they really are susceptible to listening to other people. And they even want to hear from other people on FinTwit. They want to find somebody to follow. They want to hear what, you know, this guy does or what trades that guy's in. And they really, really don't have a lot of confidence. They're looking for somebody else to tell them what to do. Now, talented, successful people in their careers sometimes are the worst traders. They think they can just transfer their career success to trading. And they forgot it takes many, many years. You know, you can take 10 years of medical training to become a skilled doctor, as an example. You know, some people that are very successful are perfectionists, but we all know that the market is not perfect. It's all about uncertainty, odds. We've got to be very, very flexible of when to back off and when to put our foot on the gas. You know, if you come into trading saying, I'm expecting to be successful, you can get very disappointed and very frustrated and make a lot of mistakes. If you're biased, you have hopes and wishes, that can get you in a lot of troubles if you don't have sound principles and sound rules. When the market beats to its own drum, you know, we got to capture what we're doing. It's good to keep a journal, you know, to capture the setups you're using. What were you thinking at the time? What were your emotions at the time? A journal is great when you're doing your post-analysis to find out where your weaknesses are. Trading is really a decision-making venture. You know, if you think about it, you're getting paid to make either a buy, sell, or hold decision. So you got to get comfortable with the ambiguity. We're making bets. We want to have a belief in we have a sound system. We have an edge. We have a process. If you lack confidence in your own system and you don't have a system, you're never going to follow a trade plan. And if you have doubt about your system or your process, you're going to get anxious, you're going to make bad decisions, and you're going to operate with fear. And trading off your emotions is not going to give you consistent winning results. So confidence is one of these things that is really tricky in the sense that, is it dialed too high or is it dialed too low? Overconfidence can lead to a lot of problems, just as well as underconfidence can lead to a whole series of problems. And I draw this diagram because If this were overconfidence, and that means you're taking big positions, you're getting really overconfident, you're ignoring risk, you're on an emotional high, you're on a winning streak, and you're loading up on positions. For somebody who's lacking confidence, you're scared, you're taking big losses, you're holding losers, you're not in sync with the general market. The line between these two is very, very thin. And it brings its own challenges. So what are signs that we can look out for, that we can monitor ourselves in terms of, you say, when will I know if I'm in an overconfident state of mind, in my mindset? If you start loosening your risk management parameters and start saying, well, I typically have a 5% stop loss, but I'm up on the year a lot, so I'm going to use 10 and I'm going to double the position size. If you start tweaking that and making it loose, you might be getting overconfident. If you start taking trade setups that really don't fit the trade setups that are part of your system or part of the system trade setups that you're successful with, you start wandering a bit into other people's trade setups and taking marginal setups, you're probably getting overconfident. If you get lazy about your decision-making process, you start not following your weekly routine. Oh, I don't need a watch list. I'll just focus on this stock because it's a hot stock today. If you're not following your routines and getting lazy, you might be getting overconfident. If you overestimate what you know, and I'm going to say when you start to boast about your win streak, or you start posting things on Twitter about how you made some big trades, or even criticizing others, you might be overconfident. If you had a good year and you start saying, wow, if I just extrapolate these gains and do this performance for the next 16 months, I can retire. You start doing the extrapolation game, you're getting overconfident. If you have an attitude of, boy, I've got this nailed, I've really figured out the market, and I'm just going to be printing money. All of these things are signs that you're usually reaching an overconfident state of mind, which can be really, really dangerous and let your guard down. Some other subtle signs that you're getting overconfident: you refuse to take profits at your targets. So if you're following a system where you're systematically taking profits at 3R, 4R, 5R, and all of a sudden you say, well, I'm not going to take profits at 4R. I want more. I want more profit. That's greed. That's greed creeping in, and you're starting to get overconfident. If your scenario planning goes out the window, you don't have a plan for offense. You don't have a plan for defense. You don't have a trade plan for the day. You say, I don't need those. I'm up big this year. You're overconfident. If you start taking unplanned trades because you say, I'm up big, I got house money, so I can afford to take a whole bunch of other trades on tips. I'll do what this guy said on Twitter, and I'll take this trade over here, and they're unplanned, you're overconfident. If you start to ignore your buy or sell rules, thinking, why do I need sell rules? I'm printing money. You think you can't lose, you're overconfident. And if you start to justify, well, I can plunge in and take huge positions because I'm picking winners and I'm on a hot streak, those are really, really dangerous. You're basically straying away from your entire methodology because you're overconfident. So if you see these things happening, or if your trading buddies see these things happening with you, have them tap you on the shoulder and say, look, what's happening? You're getting way too overconfident. Now, underconfidence can also be a real problem, and when you have a string of losses, or you've had a sustained drawdown, or maybe you really botched a trade and you had a big loss and a mistake that you made, it can really screw up your psychology and your confidence going forward. If you become overly focused on your P&L and not on your process, that can be a sign of underconfidence because you're not trusting your process anymore. You've lost your confidence. And if you start questioning your entire strategy and your methodology, saying, I don't even think this methodology works anymore, even though you've used it for years successfully, and you have these negative thoughts and you're getting negative feedback from the market, and you say, geez, maybe I should just quit. This is too difficult. You certainly have lost confidence. If you get embarrassed saying, I'm making bad mistakes, all these other people around me are making money and I'm making bad mistakes, you know, I must be doing something wrong. If you feel like your previous success you've had means nothing, you're losing your confidence. Now, if you're an experienced trader and you still think everybody around you is smarter than you and better than you, you've got a confidence problem. And sometimes it can be really, really difficult to get back your confidence. So other signs of underconfidence are, if you feel your trading is just like a car stuck in the mud, you're like, I'm not making any progress. All these people I see on Twitter and FinTwit and YouTube, they're making all this money and I'm just churning. I'm not making any money. And you say, you know, maybe I should just take a big trade, and you end up digging the hole deeper. And, you know, these negative feelings start to build up in your mind, and they start to creep into your subconscious. You know, you think every time you get a negative feeling, you know, it really draws you down. And you feel, I got to make back these losses. And I got to make them back. I got to remove these bad feelings that I'm having. These are all signs that it really is about your confidence and your plan. If you find yourself saying, well, I got to figure out a home run trade, I got to get big size, who cares if I have to take extra risk? You're really, you know, you're just straying from your methodology. Very dangerous to do. So let's talk about a few things that we might want to consider to try and, you know, work our confidence. First thing is what I've been talking about, monitoring it. What are the signs of overconfidence or underconfidence? Keep a journal and quick entries. Why did I take the trade? What was I thinking when I placed the trade? What was I feeling at the time? It's important to capture that in your book. So when you go back, you know, at the monthly or the quarterly review of your post analysis, you want to look at those notes and you want to capture those quickly. You know, that day that trade maybe gets closed out, jot down your notes about the trade. You want to capture it while you're in that state of mind. So you also want to look at monitoring yourself every week and every month. Are you following your rules? Are you following your process? Did you take unplanned trades? Are you straying from your routines? And if you find, yes, I'm not following my routines, or geez, I violated my rules, you want to identify when you kind of are going off the rails a little bit. So that's why it's so important to actually give yourself credit. When you follow your rules and you follow your process and you're avoiding big mistakes, you need to give yourself credit, and you want to look at that as a positive. That is a positive, following your rules and process. You know, failure on a trade and taking a loss doesn't mean that you as a person are a failure. Okay, that's important. There's going to be, we've talked about it ad nauseum, there's going to be lots of losses. Just keep them small. So getting back to basics is the next thing that we can do. So what I mean by that is spend more time into simply executing your strategy. Make sure you refresh yourself. What is my strategy? What is my edge? And I want to start there and get back to the basics. If your post-analysis is revealing that you're not executing well, then you need to really find those mistakes, find those repeated mistakes. Now, in doing post-analysis, I know sometimes it can be overwhelming, but what you're looking for in post-analysis is important. You're not looking for every mistake that you made. You really want to find repeated mistakes. If you find for the last 5 trades, you were chasing stocks above the proper buy zone, and you're making that mistake over and over, that becomes a candidate to say, that needs a rule. Because it's a repeated mistake. It's plaguing your trading. You want to have a rule. You don't want to get trapped into saying, well, every mistake I made, I want a rule, because then you're going to end up with about 150 rules, and that won't be manageable. So focus on repeated mistakes and try to correct those, and you'll find that your trading will turn around faster. Patience is key. If you start digging a hole, that you have to really digest that and say, yeah, I made a series of maybe some bad trades. Maybe I made some big mistakes. I took a bigger drawdown, but I have to accept it. And I have to accept that it's going to take time to work out. You're going to have to rebuild in kind of a sustainable way. Forget about the home run trade that's going to be a Hail Mary to save you. You got to start small again. And sometimes building up your confidence is doing just that, starting very small. And sometimes that means saying, going real small, saying, I'm only going to buy 5 or 10 shares. I want to execute this trade properly with a stop loss and my profit target. And I want to get my execution down. Get back to process, do your planning and scenario, and executing better. You know, one simple strategy is take a very small trade, get green, and get out. And you take a trade and you get up 5%, sell it. Just that process of getting green and selling out that trade, you'll be surprised how that will turn around your psychology. Even though it's probably a meaningless gain, you got green, you sold, you took a profit. All of a sudden your brain says, okay, I can do this. Now I can scale back up, try to build my confidence up into trading where you normally want to be. So sometimes going very, very small to get your head back in the game with the basics can really, really help turn around a lack of confidence. So the third practice is seeking stable confidence. And this is, your perspective of market chaos will adjust more quickly. Being aware that the market is going to do anything it wants to do, you need to stay flexible. And if you're comfortable saying, look, if the market gives me negative feedback, I back away. I reduce exposure. I maybe raise my stops. If the market is giving me positive feedback, that gives me the right. I have positions that are gaining, then I can actually put on some more exposure. But you just got to be very flexible with the ebbs and flows of the market. We know the market is out of our control. There's nothing we can do about that. So we want to be, you really want to be anchored to a rock that can withstand a hurricane storm of the market. And that's your system and your edge. That's your methodology. That's your anchor. Okay, so you know that you can actually stay in sync with uptrends and downtrends and execute your edge when you're in an uptrend and back away and go back to cash if we're in a downtrend. You can incrementally improve your confidence, go back to executing, go back to your routines, and stay balanced and be very self-aware of what you're doing. It can all start to help you with your confidence. So there's a lot of intangibles. We've covered only 4 of them tonight. And we'll take questions on confidence in just a minute. But there's all these other ones: discipline, self-awareness, flexibility, resilience, respect. These are actually the ones in gray. These are things we talk about at Rain King Insights inside the memberships. There's way too much we could cover in this, but hopefully these 4, I picked these 4 because I thought they'd be the most useful to people. But if I were to try and really wrap up this talk and say, what are the common reasons that traders lose money? Number 1 is bad discipline. People are disorganized. They only have partial trading plans. They've only thought about the buy side, not the sell side, and they're too casual about it. They don't treat it as a business. Second thing is they don't have enough edge. They don't know what their average gain, average loss is, and they don't really build a trading plan built on edge. Or when we looked at that chart, they think they have an edge, but when you look at the chart, you really don't. Too much focus on trader setups. Everybody wants to focus on how to buy, when we really should be focusing on how do I manage my risk? How do I avoid a big drawdown? How do I do post-analysis that helps inform how I do my setups in the future? Too much on just buying. Emotions. Again, we're all susceptible to these. We all fall prey to emotions. And if you have no methodology as your bedrock and you're going to make emotional decisions, you're not going to be very successful. And believe me, the market is going to find all your emotional weak spots. We all have different emotional weak spots, and the market will find them in you if you don't go in with a plan. And overconfidence, we just talked about this. I think this is really a very thin line between you want to have confidence, but when does it get to a point where it actually can be detrimental to your trading? If you get too overconfident, take big risks, you could give it all back. Or if you're on margin, you could really, really have some devastating losses. So those are the things I think are really common reasons that traders lose money. So we'll take questions in a moment, but I wanted to just wrap up with, I am launching a new website, Rain King Insights. We're planning to launch on July 1st. So just 1 minute about what is this website all about. Essentially, this website is all about education. It's about education and coaching traders to become better traders. And it's focused on 3 memberships. One is absolutely brand new traders with only 0 to 2 years experience, then intermediate level with 3 to 7, and then traders 8 to 10 plus, experienced traders at an advanced level. It's essentially lots of different courses, materials, and videos. This gives you a sampling of the videos in each level of trading. But probably the most important things is once we've done a video, we have a live coaching huddle by Zoom every month to go over the contents of that particular topic. And I take all your questions, I take all your questions to try and clarify the material and help you get a really good foundation, hopefully to go through the progression and improve your trading results. In addition to that, I've done a lot of market studies and I've never sold them to the public. I'm going to make some of my model books available to the public. I've done model books for the 2012 to 15 cycle, the 2016 to 18 cycle with some other people from the Boston meetup. I have a model book just on high tide flags, my 55 greatest winners. And then me and a couple of other people are just completing our new, called the COVID model book, which is the 2020-2021 cycle that'll be out later this summer. So I'm going to offer these through the website, and actually the general public can buy these without becoming a member if that's something of interest. If anybody has any interest in the site, send me an email to support@rainkinginsights.com, and I'm just going to put you on a mailing list. When I launch, I will have an early bird coupon with some discounts. So, you know, there's no obligation. If you send me a note and you look at the site when it comes out and it's not for you, that's fine. But just wanted to get you on a list if you were interested in a coupon. So that's where I am, and we can go back, Dennis, or take questions on anything. There's my YouTube channel, my X on Twitter, and then my email. You can reach me at any of those.
Okay, excellent. John, thank you so so much. And guys are starting to write in. One of the things, I just put a question in the chat box. Let us know what your aha moment of John's presentation was, because, you know, he put a lot of hard work into developing this presentation, as we all, us who make a living presenting do. And your feedback helps us to refine what we present so that it can be more impactful for you. Because I hope John would agree with that, is it's not about us. It's about us providing a map or a chart so you can be the hero of your own story and work your way into becoming a master trader. So a couple of the comments that came in, John, was one big aha was follow my plan consistently. Bruce says style hopping can slow your progress, so stop it, Bruce. And Brad really enjoyed the section on confidence. He basically goes in and he lets the noise on Twitter negatively affect his trading. And then he brags about the Dennis's group, but, you know, I won't go into that. Anyway. Because I tell you, I think I applaud you for starting up, a larger group and all, and offering the service, because there is so many just misconceptions, especially with people who are just starting trading. They don't understand that much of what they believe about trading is not the truth about trading. And I know I work with Mike Lamoth on Mondays for the Trading Truths podcast, and we talk specifically about that. And so any questions, guys? Said, great presentation, not too fast, keeps the student engaged. John, I did put in a link that you put in for the support at rainkinginsights.com.
Thank you. Thank you very much. I appreciate everybody hanging around for the full presentation and enjoyed a lot of really great questions. It's actually one of the reasons I've created this site, is to try and, when you read books, books don't sometimes connect all the pieces of the puzzle. And I thought, it'd be a way to try to provide education to investors and help fill in the gaps. If they don't understand a concept, I want to help people understand, connect the concepts, so they can, if they didn't understand something in Bill's book, or they said, I don't understand something in, Minervini's book, or I don't get this or that. Having somebody to ask questions and help coach you is something I wish I had. So that's why that's one of the reasons that I was motivated to provide the service. Like I said, it's based on education. At the premium level, I will say, because people want it, is I will share my watch list every week, and I will do a weekly video with my setups that the setups that I use, which are covered in the course. I will share on a weekly basis things that I think look good. So you will get setups if you're a premium member, because I know people like that.
Okay. And I will basically, let me go up to the upside here. Oh, darn it. View options. Well, yeah, I got to go down here. Hold a second. I'm going to flip over and start sharing my screen again. I think that should come up. And
Yep.
So just a quick reminder, folks, is come back. Next week, the next session, July 19th. And John, Lee, right? Lee Tanner.
Oh yeah. Lee's great.
Yeah. And Lee is a very good friend of mine. Lee and I were both in the Navy at the same time. We got our commission in the Navy through the same program, and Lee is always a fabulous thing. So to ensure you get invited directly to that, you need to be on my mailing list and or a member of the Bay Area Moneymakers. And so with that, John, I just want to say, let me turn my camera back on here. There we go. I want to say thank you so much again for a very thorough. I came up with several things that I'm going to be thinking about, because we're using the Dunning-Kruger effect and that valley of despair to help coach people through that. And the couple of things that I took away from your talk was plan for the offense and plan for the defense. And lastly, that the market will find your emotional weak spots. And that's why I became a mechanical trader, where I trust my mechanical system, and it helps remove me from the impulsive and compulsive trader that I once was.
Yeah, I hope, like I said, some people this was a refresher, and I hope that was a good refresher. Other people, this was new material. And so I hope there's some nuggets for everybody to grab a couple things, and hopefully it was helpful. Okay.
Well, for that, I'm going to sign off, folks. And I'm going to go on. I have to get on to another self-help, not self-help, but a self-improvement course that I'm doing right now with my speech coach. I'm doing a master class right now with a speech coach so I can be a better presenter. So I'll say aloha. God bless. John, thank you very much, sir.
Thanks so much for inviting me. Thanks for attending, everyone. It was great.